How is it going, guys? It is Thomas once again, and I wanted to talk about something that I got kind of inspired as I was in my open house this weekend and I was talking to a potential buyer. And some of the common things that I always hear from first time home buyers started coming up. And there's just a lot of misconceptions out there. So I wanted to do a quick video about three of the most common things I hear and kind of talk about different ways to look at them and different ways to kind of clear up the confusion that can sometimes happen. So, one of the first thing I hear is right now in this market, buyers are really concerned about high interest rates. And some things I want you to think about, some things that are facts, are interest rate buy downs, paid for by sellers are a thing right now. Even resale, more commonly in new construction, we could get you a rate bought down, either temporarily or fixed, whichever way you want to do. Temporary would be probably the more risky option because it only buys down the rate for 2 years. It does buy it down more aggressively, but you would have to figure out what you're going to do after those 2 years if you're not okay with that interest rate that it's going to go to after those 2 years. Arms are not as risky as they used to be, kind of on the same topic. Your arms, you're looking at your most aggressive one would be a 5-1. So it's going to be fixed for 5 years and then start adjusting after that 5 years. You can never say never, but more than likely, you're going to have a different mortgage option after 5 years to switch to if that interest rate starts to get higher than you feel comfortable with. The other thing to keep in mind is there are limits to how fast they can go up within a year. So you'll want to talk to your lender when they're presenting you an arm. You'll want to talk to them about that worst case scenario. Okay, so what does it look like year 6? What's the worst possible monthly payment I can have based on information that we have now? They won't be able to estimate tax on your home because they won't be able to really estimate exactly what the county is going to do with that. But something to keep in mind is arms aren't like they used to be in 2006, 2007 when they got such a bad name. They're a little less aggressive. They're more conservative than they used to be. Loan amount and purchase price are, in my opinion, actually, it's not even an opinion. This is a fact. Loan amount and purchase price are more important than your interest rate. If you could get an offer accepted on a home below market value, even if the interest rate is higher than, I'm not going to say higher than you feel comfortable with, but higher than you would like, you can always get a lower interest rate later. I shouldn't speak in absolute. You will more than likely be able to get a better interest rate later, and you'll be happy that you negotiated such a good price on the home as opposed to waiting for interest rates to go back down. Just some things to think about with higher interest rates. Um, you're always going to want to talk to a lender and just kind of get an idea what your monthly payment will be with the interest rates that they are today. And if it's just not possible to afford the type of home that you need, it's just not a good time. Everyone's situation is so differently. I talked about that in the last video that I did. But really explore the option of what would it look like if I get pre-approved now as interest rates are still fairly high but going down. What would it look like if I get approved now and start getting more aggressive in the market before all these buyers return? Because that's exactly what's going to happen. Once interest rates start to get below 5 again, you're going to get a flood of buyers back. That's just the pure facts of it. So explore those options. Start thinking about, can I jump ahead of the line, so to speak, and beat a few people out to this? Not having enough for a down payment is something that comes up all the time. Some people have a preconceived notion that they need 20% down, everything like that. So every time I talk to someone, a lot of times I hear them, "Oh, I'd love to buy a house, but I'm just waiting to build up a down payment." It kind of depends on what kind of down payment you're looking to save up. Zero down mortgages do exist. There's government-backed ones like the VA loan. So if you're a veteran, definitely look into the VA loan because 0% down on the VA product is a great product. There's USDA, which would be a 0% down loan product that they have for more smaller towns, more ag-developed towns. USDA is a great option. But look up the USDA map because you'd be surprised at how close there's USDA eligible homes in the Des Moines area that aren't that far of a drive from Des Moines. And there's some people that I know out there that are excellent savers, but the other thing to keep in mind is that your equity will likely build faster than you can save. So buy as soon as you can is my general philosophy. there's tons of caveats to this. So if you are having questions, please reach out to me. But for example, the average American saves 5% of their paycheck. So that would be about 8,200 a year on the median Iowa income. If you bought a home for $250,000 that you put 3.5% down on, and that home appreciated 4% a year, you would gain $81,791.23 in equity in that 5 years. So that's quite a bit more than $8,000 a year. It's just something to think about. That's why the people that you see that have built wealth by the time they retire, by the time they pass away, unfortunately, have most likely built a majority of their wealth through real estate. And real estate, if anything, real estate is a long-term game. You want to figure out how quickly can I buy my first one, and then start taking advantage of the benefits of owning real estate from there. So, just something to think about with down payments. Your average down payment for a first time home buyer is 6%. So, if you're getting into, I have 3.5 or I have 5, don't even necessarily beat up on yourself too much that you're not doing as much as everyone else. The average for first time home buyer is 6%. Once they go to buy their second one, it jumps up. The average for a first time home buyer is 6. The average overall is 16. So I normally like to talk to people about with your first one. Start looking at those programs that could get you 3.5, 5% down. Is normally what I'm kind of looking at. What makes the most sense for most people. And then after that, that's when I would start to look at that 20% option. If your upgrade, you can't afford to do a 20% down payment on the upgrade, that's when you kind of start asking the questions, does this financially make sense to me? If that makes any sense. So much nuance. There's, hours worth of talking that you can do with all this stuff. So if I say anything that you have more questions about, please comment below or just directly message me. The other thing, this is kind of a weird one, but I always have a lot of buyers that just flat out say, hey, my credit's not good enough. You don't really know until you know. You probably have a general idea of what your credit is around. I want to point out there's options out there for people that have credit as low as 600, 620 is normally a baseline that a lot of people throw out to you. Obviously, the better your credit gets, the better loan product you can qualify for, because your lower credit does affect your interest rates that you will be offered, and it does affect your total loan amount that you can get. But just, you don't really know until you know. So have a lender look at your credit and do that credit pull. And if they can't help you, point you into to resources that can help you get on the right track, if it is a situation where it's that bad. Or maybe you'll be surprised at what type of mortgage product you qualify for now, even if your credit is low. The other thing, I have a lot of people that are hesitant to apply for a mortgage because of the credit pull. That credit pull hit is generally not as bad as people always seem to make it out to be. It's not as bad. A lot of people happen to apply for credit cards or a car loan all in one window, and that's 2 hits. If you were to apply for 3 mortgages all within the same window, it's only 1 hit. So that's something to keep in mind. They want you to shop for mortgages. So you have to keep in mind that it's not 3 pulls, it's just 1. That's a hit, and that hit can normally quickly be come back from. So if you're serious about purchasing a home, don't wait to apply for a mortgage, because that credit hit is not as bad as you typically think it is. As always, I'm always here if you have any more questions. If you have any videos that you want me to do, please comment below. Message me with anything that you want me to cover or answer to you directly, guys. Have a great day. I appreciate all of you.